You hit your target, 3 months of expenses sitting in your account. But instead of feeling secure, you're lying awake staring at the ceiling. A friend ruined the moment at dinner. They found out you were holding cash and called it a mistake, insisting that every day that money sits still, you're falling behind. They cited the 12% historical returns of index funds. By their math, your safe savings account is a drain on your future wealth. Now it's 2 a.m., and you're deep in a research spiral of Reddit threads and YouTube finance gurus. Everyone has a different opinion. HYSA, T-bills, total market funds, and the noise is making it impossible to decide. This confusion doesn't come from bad math. It comes from a misunderstanding of what different piles of money are actually supposed to do for you. The fear driving this dilemma is inflation. If your money earns 3% while costs rise by 6%, you are losing purchasing power. That is a mathematical fact. This reality leads to the common advice to invest everything. It sounds sophisticated and aggressive, which makes it incredibly popular on social media. But index funds offer high returns because they are volatile. When you move your safety net into the market, you expose your last line of defense to the risk of a 30% drop at the exact moment you might need it. This side-by-side shows the real trade-off. On the left, index funds offer the growth to beat inflation, but they carry high volatility. On the right, a high-yield savings account offers a guaranteed 4.5% with total liquidity, even if it trails inflation. You have to choose which risk you're more willing to live with: the slow, predictable erosion of inflation or the sudden structural risk of a market crash. Human brains hate inefficiency. We see cash sitting still and our action bias kicks in, the feeling that we must do something to optimize that idle capital. Trying to optimize every single dollar feels smart, but it often creates a fragile financial life. You can look wealthy on a spreadsheet while being functionally broke during a crisis because you have zero liquid cash. An emergency fund has one specific job: protection. Chasing growth with this specific pot of money is a strategic error. Think of a shop owner who keeps a fire extinguisher in the middle of a luxury display. That space could hold a product that generates profit. But when a fire starts, the owner doesn't need a high-margin product. They need that extinguisher. Emergencies are urgent. They are car accidents, sudden job losses, or medical bills that don't wait for the market to recover. Urgency is the enemy of successful investing. When you mix your protection money with your growth money, you end up failing at both. You disrupt your compounding, and you leave yourself vulnerable when life gets difficult. Consider a scenario where you need $3,000 for a roof repair during a month where the market is down 20%.
If your emergency fund is invested, you're forced to sell your shares at the bottom, permanently locking in that 20% loss. If you choose not to sell to avoid the loss, you end up putting the repair on a credit card at 24% interest. Your investment strategy has now forced you into high-interest debt. Compare a $10,000 fund over 1 year. Scenario A fluctuates into a loss. Scenario B guarantees a $450 gain. Even with 12% market returns, the $750 gap is an insurance premium, keeping your money whole. This premium ensures you never have to choose between a high-interest credit card and selling your investments at a loss. To build protection, start with the month count. A stable salary requires 3 to 6 months' expenses. Freelancers need 9 months. Put this target into a high-yield savings account at a separate bank. When the account is full, funnel every dollar beyond it into long-term investments. Variable earners need that larger cushion because they face a higher statistical risk of zero-income months. The buffer needs to match the volatility of the career. Using a separate bank creates digital distance. If your emergency cash is visible in your daily banking app, it's far too easy to treat it like spending money. The 2-day transfer delay between banks acts as a filter. It's long enough to stop an impulse purchase, but fast enough to handle any real crisis. This structure removes the need for willpower. The friction in the system makes the right behavior automatic. You should audit this number every 6 months. Your life isn't static, so your safety net shouldn't be either. If your rent goes up, your target needs to rise. If you pay off major debt, your monthly expenses drop, and you can move the excess cash into the market. Today, you're actually being rewarded for doing the right thing. Take advantage of it. Wealth is built in layers. The first layer isn't returns. It's not compound interest.
It's not picking the right stocks. The first layer is stability, the ability to handle a $3,000 problem without it becoming a $30,000 problem. When your emergency fund is solid and protected, you get to invest with confidence. You don't have to panic sell. You don't have to hesitate. You don't have to wonder if the market dips, whether you'll be forced to pull out at the worst moment. Your investments can breathe, and investments that breathe grow. The friend at dinner was wrong. Not because index funds are bad, they're incredible over the long term. He was wrong because he forgot that not all money has the same job. Some money is a soldier. Some money is a doctor. You don't send your doctor to war, and you don't send your soldier to the hospital. Put your emergency fund where it can protect you. Then, and only then, let your investment money do the heavy lifting of building your future. That's not settling, that's strategy. And now you know the difference.